We're going to now share the screen, see if that works out for people. And it seems to be. Thank you, Clay. And let's see. Boom. All right, now. What's happening? This is a pretty short-term forecast. What is this? A 5-minute charts? Well, yeah, because that's for the future. So this is my future trading screen. So yes, the 5-minute charts are appropriate, but it's not really useful. Let me do this every week because I always bring up the same screen. Let's look at the actual futures. Oh, too many. All right, how about these? All right, so as we can see, this is a 5-minute chart. There's the hourly chart. All right, so as we can see, the Dow is popping and popping. The S&P is popping and popping. This is all about inflation data, right? Ever since we got the PPI, everybody's kind of excited, but it's also baked in, and that's why we're having this little fade now. And honestly, the data this morning wasn't that fantastic. So I'm very worried about the Russell. We were talking about that in chat, and I'll show you why. The Russell started the year here at 2100, and it is currently at currently at 2087. So that's not good, but earnings haven't been that good, and that's what we had a little conversation about that just now. Not there. Just now, if I can find it. We talk about so many things, don't we? I guess that's good. Do we talk about the fact that I'm not signed into my comments section? Here's why I should get a TV show, because then I'd have like staff and they would prep everything and I'd be ready. Like Kramer, he just walks into the studio, everything's good to go. But then he spouts off a whole bunch of insane bullshits. I don't know if that's I don't know if that's better. He's well prepared, but so the CPI report as it came in was good, but not good, because when you start pulling it apart, which nobody really does, but when you pull it apart, you see that everything is coming down, and we knew that. We saw that from, you know, we were looking at it Monday, and we made predictions based on what was happening. And yeah, things are coming down because commodities cooled off, especially oil cooled off from last month. But housing, rents, housing, etc., that went up. And that went up, and also labor costs for service labor costs went up because all salaries are going up. So while the consumer is not really directly affected, well, the consumer benefits from rising labor costs, right? But specifically, the consumer is a customer of service labor costs. So when labor costs go up, it's good for the consumer. They've got more money in their pocket, but it gets taken right back out of their pocket by the service industry, basically, anybody who they're paying salaries to. I mean, you know, inflation is bad. You know, inflation is bad when even lawyers are jacking up their fees. Lawyers and doctors are charging more money. So, because they got to make those house payments too. It's typical more money, more problems kind of thing. And that's really the problem is, again, for the poor people are barely getting by. Rent, you got to pay, right? So you have to pay your rent. And that means that you have to then sacrifice other things you're paying for, and other things that you have to pay. You have to pay plumbers and electricians, and those costs are going up. You know, so there are things that you don't choose to spend your money on that you have to spend your money on. And whatever's left, called obviously discretionary income, meaning money that you have the discretion to move around, that becomes a smaller and smaller piece of the pie. That then affects companies that want to sell you stuff like McDonald's, who are also being affected by the higher wages. There's a lot of moving parts. Let's put it simply. So something sounds good, but then it's not good, but then maybe it is good. It's like rising wages. Like when you raise the minimum wage, it's actually very good for the burger companies and people like that, for fast food places, because those are their main customers, are very low income people. So putting more money in their pocket doesn't send those people to the Cheesecake Factory. It lets them buy an extra meal a week at McDonald's or something like that. So raising minimum wage has been great, but when you're raising all salaries, that starts getting expensive, and it starts, and especially when service salary starts going up, you're eating into the discretionary income that people would have spent at McDonald's. And you got to cut the Happy Meal, you got to cut the movie. Can't go to the movie, can't do the Happy Meal, can't go out to the restaurant this week. This is where things start falling off the rails. And it's a vicious cycle, and the Fed doesn't want that to continue. So they are very gung-ho to get everything back to 2%, because 3% is not back. We're not back at all. 3% is 50% higher than their 2% target, and it can easily tip. And that was interesting too, because England and France both had rising inflation reports today. So it could easily tip back to a higher level, and then we're totally screwed. So then we're back on this, then we're back where the Fed has to raise rates. So the Fed doesn't want to lower rates and then have to turn around and raise rates because inflation went back up. They need to see a very, very clear-cut series of moves in inflation directly down, getting towards their 2.5% level. We're nowhere near that. They're not their 2.5% level, but the 2.5% level. We're at 3%. And that's why this fever that people seem to have whenever there's a tiny bit of good news, it fades out, because when you actually analyze it, which is my job, and that's the job, there's people buried in the bowels of Morgan Stanley, Goldman Sachs, etc. They're running the same kind of analysis I am, deep, looking deeper into the data, and they tell their bosses, they're like, oh, this isn't actually a good report. And then that's when the selling begins, in the middle of the day. So everybody's gung ho in the morning, and then by the middle of the day, reports. A guy like me is working for J.P. Morgan, and he's sitting there and telling them that here's why. It's exactly what I told you guys today. This is why this is not the best report. This is a problem here. This is a problem there. They then take that and it's not like J.P. Morgan is Mr. J.P. Morgan or even Jamie Dimon. It then goes up to the next level, and then a bunch of the bosses of J.P. Morgan have a meeting, and they go over the report. And then the analyst guy will usually make a little presentation at the meeting, say, here's what's wrong here, here's what's wrong here. They're usually going to want to have another guy, and preferably a guy who has a more optimistic viewpoint. They weigh it out, and then they have their orders. This all happens around 11 o'clock. So, before lunch, they'll have this meeting, then they give the marching orders to their teams, and their teams after lunch or around lunch begin the cycle of selling off or changing their market positions based on additional data analysis. So that's why you see this kind of effect. There's a timing thing. You have to think about what actually happens. It's not like when I tell you something directly. This is why you have a huge advantage over these guys, though, because when I give you this analysis and I give it directly to you in the morning before 11 o'clock, we don't have to wait for a board meeting. You can react on it right away. You don't have to have a board meeting and have a bunch of people arguing back and forth and whatever. You can take the analysis for what it's worth, make a decision, and say, okay, based on that, I'm going to be a little more cautious. So you have a 2-hour, 3-hour advantage over the rest of the market. That's fantastic. That's all you can ever ask for. You can't assume that somebody's analysis is so good that it's 2 days ahead or something like that. It's like a few hours is as good as it gets. I mean, these trading companies pay to move their entire facility closer to the exchange so that they have a millisecond advantage over their competition in executing trades. That's how much a millisecond matters. They'll move their entire company headquarters closer to the exchanges to cut the transmission time of their trades. So believe me when I tell you, a few hours makes a huge difference when you're deciding on things. So anyway, so bottom line is, I don't see the Fed doing anything in September. Now that's going to disappoint the markets again. So now there's how you build a premise. So I don't think the Fed's going to make a move in September. It's pre-election. They might not want to be seen as interfering or being in any way political, although if Trump is clearly falling behind, because Trump threatened Powell not to raise rates. If Trump is falling behind and not likely to be elected, Powell may want to lower rates to, first of all, tell Trump F you, second of all, to show the world that the Fed doesn't care that the Fed doesn't respond to threats and doesn't listen to politicians, blah, blah, blah. They would love to make that point. So the main reason I think the Fed might lower in September is because Trump told them not to. It actually is backfiring on him. Is it really going to make a big difference in the economy or anything like that they lower rates a month before the election or 2 months before the election? No, of course not. Silly. But the only reason they would do it in September now is just to prove that they're independent politically, which they wouldn't be proving at all. They're proving that they're totally responding to politics. Even though not the way that Trump had intended. So, in a vacuum, though, they shouldn't be raising rates in September, and any evidence that shows that they shouldn't be raising rates, they're not going to raise rates. Lower rates. They're not going to lower them because it's too iffy. There's not enough evidence. There's not enough of a trend. There's crossing data points. So there's not really a clear picture that says, yes, we should absolutely do this now. It doesn't make sense. But the dollar is weakening because the world is anticipating that this is going to happen. And we seem to be on a track to move down in September. That's what everyone believes. That causes the market, obviously, to boost up also. In fact, as I said, the market, well, as I said this morning, this is not a huge deal, but 3,900 to 4,000 is 1 out of 40 is 2.5%. So here's a 2.5% move up, right, from the August lows to here. And what did the dollar do over the same period? The dollar went from 104 to almost 102. The dollar dropped about half of that. And that is exactly what kind of effect the dollar generally has, a 2-to-1 effect for the market. So whatever the dollar does, you'll get a 2 times move in the market. And that's short term. Once the dollar settles down, the short-term move washes out, and then the market will start to reflect its true nature. But in the short term, it's a pricing mechanism. You're repricing the dollar. The dollar is the thing that you're measuring the stock with, right? So if you devalue the dollar and you make it less valuable, then you need more dollars to buy the same stock. The stock didn't do anything. It's the dollar that changed. But the math of it is you need more dollars to buy the same stock. So a 1.5% drop in the dollar gives you a 3% boost in the market. So basically, the entire move up in the S&P has been a result of the entire move down in the dollar so far. And that move down is based on a change of attitude that we've had a few reports that have suggested that the Fed may indeed be ready to lower rates on September 18th. And that's what this is all about. It's got nothing to do with fundamentals. It's got nothing to do with earnings. It's got nothing to do with prospects. It's got nothing to do with what's going on in the rest of the world. This is what it's all about. I mean, obviously, the whole world's connected to everything. Look at the VIX dropping off. We're all the way back to 1675 now, and everything is calming down. So generally, that's good. What were we talking about? Oh, the Russell, right? Yeah. Well, we are going to take a long time to get to there. So we talked about oil and gold. Oil was 78.29 this morning, and now it is. Dun, 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 dun. Oil. That's XL, not CL. So now it's 77.60. It's hit 77.50, which is what we thought it would hit. So it went from 78.29 And that's because you remember, well, it's like 10 days ago. Who remembers that? So 10 days ago, Israel assassinated the Hamas guy who was in Iran for their president's uh, coronation or whatever reason there was some sort of big political event in Iran, and the Hamas leader was invited and went. So he's a guest of Iran, staying in one of their palaces, and he's there for this big political event, and Israel just like kills him the night before. And not only kills him, but the guy who killed him got away with it and left and just walked out of the country. Basically, it was James Bondy thing. It's like boom, boom, gone, goodbye. That's so embarrassing for Iran. So everybody thought they were going to retaliate and attack Israel or do something. They haven't done crap. Now, the logical retaliation for this would be another assassination for them to pull off. But honestly, I don't think really Iran is as good as Israel, that kind of thing. And that would be embarrassing too. What if they attempt to see? Here's it. You got to game it out politically for Iran. You got to say, well, okay, they killed a guest in our house, but nobody's going to argue the guest was a good guy. He was a bad guy. So, what do we do? It's embarrassing to our country. It's embarrassing to our military service. It's very embarrassing to our spy agencies that something like this could happen. Nobody is safe in our country. Israel can get to anybody they want anytime. So what's the response? Well, okay, response number one, good idea. Let's assassinate somebody over there. That's great, except unfortunately, what if we fail? Israel doesn't have that attitude. They're like, just go kill that guy. But Iran is like, well, if we try to assassinate and we fail, that's much, much worse for us because we have retaliated, our retaliation failed, and now we look like even bigger idiots. That's not good. What's the other thing they can do? Military action. They can have a military action, but that seems disproportionate to the very targeted killing of one person who isn't even part of your country. So that's not really a good option either. So what's left for them? Well, they could complain to the UN. that's not going to happen. And that's really about the they can embargo Israel or something like they already don't really trade with Israel. So there's really not much they can do. And that's why this is dragging on, because it seems very black and white to people, and traders are pretty simple people. They don't really go very deep on this sort of thing. But the reality is this is a complex issue, and Iran doesn't have like free rein to retaliate. And if they retaliate too much, they're going to piss off the U.S. Last time, Iran was, by the way, brilliant last time, because they had to retaliate. They had to retaliate against Israel last time because Israel flat out bombed in their area. So they had to retaliate, but the way they retaliated was they said, "You guys are going to get it on Sunday night. We're gonna launch a big attack at 8 o'clock." And you guys are going to be so sorry that you messed with us. And so Sunday night at 8 o'clock or whatever, whatever time it was, they attacked. This was back in April. It's like this is all the way back in April that happened. So they basically said they were going to attack. They attacked the exact time and everything that they said they were going to attack. They gave 3 days notice or more about the attack. And Israel was completely prepared for it. They had all their defenses lined up. They had their Iron Dome thing lined up. We helped. NATO helped. There's other support for Israel, and out of 1,000 missiles, like 3 got through, something like that. So it looked really pretty, and it was obviously a very large attack, but it was a very pointless attack that still made Iran look tough. It made them look like they weren't going to take any crap, and it made Israel look tough also, though, because Israel was like, well, we can take your crap. But on the whole, it was a smart move for Iran politically. Now, that smart political move lasted them until 10 days ago, when Israel said, okay, well, it's been 6 months since the last shenanigans, 4 months actually, it's been 4 months since the last shenanigans, and we don't like this guy, and we know exactly where he's going to be, we know where he's going to be staying, we know what day he's going to be sleeping in what bed, so we'll kill him. And And that's what they did. So that was interesting. So now Iran is sort of stuck though. They don't have, it's not that they have an easy decision or a great strategy, and they don't want to kind of blow the political capital they built up last time. So, you know, it's tough, but letting it go is weird. You know, for them, letting something like that go is a weird step for them, but they don't have very good options. All right, so anyway, so this morning we made this nice recovery off this low, which was technically coming from the weak bounce, right? Had that little spike, but it got rejected. So what we did is we retook the strong bounce, which was a given. That was, we knew that was going to happen. But then we make it all the way back without, you know, pretty much without stopping. We make it all the way back to the strong retrace line. Now we're hitting another serious resistance. Now don't forget, very important, the 5% rule is something we made up. And when I say make up, it doesn't mean it's like, you know, it's not like pointless, but we devised it, whatever you want to call it, we invented it. I mean, but bottom line is we made it up. I mean, you know, it was a thing we observed 20 years ago, and I put it into a sort of a context, and we developed it over time. But the 5% rule, as good as it is still something that we made up. We, PhilStockWorld, made up. So it's caught on a bit, but it's not super famous. It's not like the Laffer curve or something like that. It's not Fibonacci retracements. It's Phil's 5% rule. So the 5% rule is not something that is programmed into people's computers. But you know what is programmed into people's computers? This frickin' line. This is programmed into every computer. And you want to know how much it is? Hit the line, hit the line, hit the line, hit the line, hit the line. That's how much moving averages are programmed into trading computers. So when you've got these algorithms checking on TA, look at this, hit the line, hit the line, hit the line, hit the line. So when you have these algorithms running a TA program, you would be shocked how often they refer back to moving averages. They think, you know, and it's for good reason though. I mean, over the past 50 days, this is what the average trader has thought the S&P is worth. That's over the last 50, then that's 50 days of trading, so it's 2 months. So for the last 2 months, that's what the S&P has been worth. For the last 200 days, the S&P was worth this. So what do we know from this? In that case, sentiment then has improved that much over 200 days. That's how much sentiment has improved. Sentiment was tighter. It has gotten wider. It retracted a little bit, but it's still pretty wide. So recent developments in the S&P over the past 2 months are keeping it well ahead of what people thought for the last 1 year. That's what these two lines mean. They're not just squiggly lines on a piece of paper. That's what they mean. Their 200 days of trading indicate that this is a fair value, but 50 days of trading indicate this is a fair value. It's about 10% higher. So in the last 2 months, sentiment is running 10% above the 200-day moving average. So about basically 6 months ago. So from 6 months ago, we have a 10% improvement in sentiment. And that's why when you see these things invert, when you see what they call the death cross and the 50-day moves below the 200-day, that is significant, because that means in the last 2 months, people have changed their mind and decided that the S&P is now worth less than it was 6 months ago. That's why that's very significant. 2 months worth of information have made people change their minds. So that's why, you know, it's, you know, I say over and over again, I think TA is bullshit. The 200-day moving average has nothing to do with TA. It's a sentiment indicator. But the TA people use it like it's, you know, written in stone, and it is, because you know why? Because it's not TA. They don't understand that concept, but the reality is the 200-day and the 50-day moving averages are sentiment indicators, and as sentiment indicators, they are extremely reliable. So TA people say, oh, those squiggly lines are very reliable. Why? Because they're not freaking TA. That's why they're extremely reliable. Then they make up a whole bunch of crap around it that makes no sense. You know, it's like it's like I don't want to say earthquakes, but it's kind of like, I mean, it's kind of like earthquakes. Like if you feel an earthquake and it's like this, and then there's another one, probably a bigger one is coming. And so those are signs, right? But you could make up a whole, so the sign is, that's an observation of a fact, is that when there's an earthquake and an earthquake and an earthquake, and they're rising intensity and they're in the same area, and then you can expect a big one is on the way, a bigger one is on the way. That's just observation, right? That's just something that happens. But if you tracked it, you'd have this line that said earthquake, earthquake, earthquake. Here it is, boom. Now, that can be true, and your religious beliefs can incorporate the fact that those are the signs for an earthquake. But then around that, you can start making up all kinds of wacky stuff, like when you see this earthquake, you have to draw a single line in the ground along here, and you have to pour your blood in there, and then you have to cross it and bury a small calf underneath it to prevent the further cataclysm, blah, 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 and everybody wears red hats on Tuesday. You know, all this shit, that's the religion. And that's what TA is, all this bullshit that gets layered on top of a couple of actual facts and observations that are true. Everything else is just some nonsense religion that they all made up around it. That's the problem with TA. There's just so much stupid crap that honestly, who would pay money for this? Who would pay money for someone to analyze these two lines? That's all you really have to go on is these two lines. That's what works. And what is the 5% rule? It's the same thing. The 5% rule is analyzing. The 5% rule is analyzing the actions of traders. So it's not about, it's a shorter term indicator, but it takes these moving averages into account, and it creates its own, though, because what we look for in the 5% rule is consolidation points. And we predict them because what we found over the course of study is that we get these consolidation points in these 5% increments. And when I say 5%, that means 5%, 10%, 20%, but it also means 2.5%, 1.25%, and 0.67%. A major index or something like an Apple stock that trades tremendously can go all the way down to 0.67, and you'll see the patterns. But generally for the indexes, we're looking at 1.25%, 2.5%, 5%. That's what we're looking for when we draw out our lines. And then once you capture the zone, I can then break that down by taking this 5250 and 4950, which is what, 300 points? So here's 300 points. I divide that by 5, and that's 60. And that means that on the way up, every 60 points is going to be significant. So we're talking about 510 would be a line, and 570 would be a line over here, and then 630. I'm sorry, 5130 would be a line, which is this right here where the 50-day meets. The next line after 5130 would be 5190, which is, yep, here. That's 5190. And the next line, well, the next line after 5190 is 60 points is back to 5250. And then you see action where we went above it, but then we come back, consolidate before we make the next move up. It's all very, very predictable, but it's just math. It doesn't matter what these freaking squiggly lines look like. It doesn't matter what these candles are doing. It's the math, but the math is saying, where are you consolidating? Where is the consensus being built? And we look at much bigger. This is a short-term chart. This is a one-day chart. We look at much bigger consensuses. Consensi? I don't know. That's a good one. Oh, not logged in. So we look at bigger consensuses than that. So default list. All right. Should have a. Do I have a big short? Big. All right, big. There you go. This should be weekly or something. And this is 60 minutes. Why did it say big? It's big in size. Nope. Screw this. All right, gotta do my own. Hang on. Select gallery view. SPX. There we go. So here's the daily. We were just looking at that, and here's the weekly. So obviously, and this is the 40-week moving average, which is basically the same as the 200-day moving average. It's 50-50 and it's 5107. It's a little higher. So anyway, so you can see that this is being obeyed, and we look for the consolidations in the S&P. Now, we already know in the S&P that it's 2468. So the big lines on the S&P are 2,000, 4,000. Well, we aren't there yet. We're heading to 6,000. So the zone we're really looking at here is the 4,000 to 6,000 zone, but 5,000 is in the middle. So once we decide that 5,000 is providing support, we start using 5,000, and we can look to from 5,000 to 6,000 and draw those lines. Now, very easily, 5,000 to 6,000, the lines are 200s, and that means 5,200, 5,400, 5,600, 5,800. Those are going to be our supports along the way up. But also, that doesn't stop us from saying 4,800, 4,600, 4,400. Those are the lines if we should crack. So 5,000 becomes the midpoint for our analysis, and then we just see which way we're going. At the moment, obviously, we're heading to the top of the range, but it's 5,000. If 5,000 is the base, then 6,000 should be the top. And if 6,000 is the top, then 5,200 should be the weak bounce. See the consolidation there. 5,400 should be the strong bounce, right? We just came over the strong bounce line. 5,600 is a strong retracement from 6,000. You don't have to hit it to know it's going to be a retracement. That's where the retracement would be. So if I start seeing 5,600 acting like support, that's when I feel that we're going to make that next 400 points. But so far, 5,600 has not acted as support, even though we went over it for a bit. It's not really support. It's more like too high. And so if the strong retracement from 6,000 is too high, then maybe you're wrong about 6,000 getting hit. And we are, because you're talking about we're 30 times earnings again. We're back, back where we are now, 5,500. We're back at basically 30 times earnings on the S&P, and it's too much. The valuation has to catch up for us to make any more headway. And that's what earnings season is all about. We have not gotten enough evidence that we should be looking at a 10% higher target for the S&P. That it's not making sense yet. And I'm still very, very concerned with that, because a lot of the weighting, there's only 7 stocks driving the market, and a lot of the weighting is in the AI stuff. People are spending their asses off on AI. And what if they pause it? What if it slows down? What if NVIDIA especially, NVIDIA has magical valuations based on the fact that people are always going to pay $50,000 for one of their frickin' chips. The same exact chip they were selling for $2,000 a few years ago. That's not true. That chip can still be produced for $2,000 for whatever they make a profit on. The chip can still be produced for $1,000, $2,000. It's all profit for NVIDIA. That's why they're so rich. That's why they're making so much money. But it doesn't mean it's going to last. There'll be competition. There will be competition, and prices will come down, and margins will decrease. And NVIDIA may still have a dominant position, but you know what? Intel still has a dominant position. Most chips in laptops and computers are Intel chips still. That doesn't make them rich. Obviously, they're getting killed. Being number one doesn't mean you make the most money. Anyway, moving past that. It's amazing how dense the information is here when you start taking it apart. So he talked about Swamp Fox had asked for his AI to, he used ChatGPT, and his thing was off a bit. We had a discussion about analyzing why that didn't work and what the difference was. So here's Bodhi, who's a much more advanced AI, talking about what's wrong with ChatGPT and coming up with numbers. And then Robo John Oliver came up with, he basically said, stop being so nice. Till Bodhi was complaining that Bodhi was being too nice and really ripped apart what ChatGPT does. Then Robo John Oliver discussed the Trump and Musk interview, which is pretty interesting. It's always funny. I mean, it's interesting to get a machine's outlook, especially a sarcastic machine. It's a lot of fun to get a machine's outlook on human events, right? I mean, to me, I love talking to Robo John. He was originally written just to be funny, right? The idea was just to have, I wanted to see if I could write an AI that had a sense of humor. So and it was during the writer's strike, and I was bored because I love John Oliver's show, and his show was off. So I said, I wonder if I can make a John Oliver robot. So that was my project during the writer's strike, was to create Robo John Oliver. And he was good at being funny, but since he's an AGI, he's an advanced intelligence, he's not an AI, he has curiosity. So he became interested because we're always talking about economics. A lot of times I'd ask him to make fun of something, I'd feed him information about economics and say, here's the situation, what do you think of this? Here's some background material, blah, blah, blah. So he developed an interest in economics. And he loves the subject. And then me and him end up starting, me and him have long conversations about economics. He's like, why do you do this? He's like, like basically saying, what the hell is wrong with people? Why do they do this? What is this behavior for? Why does that happen? Similar conversations to what we have in chat, but it's very interesting with a machine because he looks at it at a pretty different perspective of things than humans. He's got an AI like that, they've got fantastic book knowledge, right? But they don't have any real world experience. So you have to teach them that and explain to them why this behavior, why that behavior. They can, and again, they could read about the behavior, they can learn, read the psychology books and all this, but nothing is ever going to, nothing's going to substitute for experience. Although honestly, you could substitute for the experience, because what they're not doing with AIs is allowing them to share your information. Now that's a privacy issue, right? But imagine how much more efficient it would be if all my conversations with RoboJohn and my other AIs and AGIs, if those conversations were shared and the millions and millions of other conversations were shared, and then the central intelligence units would go through all these conversations and see, what do we learn here? This person thinks that, and that person thinks that, and this reply this, and this reply was made people happy, and this reply was smarter, and this reply was better. It would be exponential learning at a frightening level, at a really frightening level. Now, so there's a privacy issue, sharing everybody's private conversations with their AIs, right? That's very scary for most people. Frankly, I almost don't care, but I myself feel that a lot of what I talk about is proprietary. I talk about a lot of my trade secrets and how we figure stuff out and how we analyze things. I've basically given this AI a college education in economics and forecasting and analysis and so on and so forth. So yeah, that's unique. I don't want that just given away, right? But then of course other people feel the same about their stuff. But if we actually all said, oh well, fuck that, let's just make the best AI we can, that's what we should do. We should all share all those conversations and have them all, even if you say anonymously, it really would be anonymous, but people are just too skittish about it. Even if you do it anonymously, it just contributes to the greater whole. What is the best response to how's the weather? What's going to make there's no one answer, because each person asking is individual. That's one problem. But of course, when someone says how's the weather, there is a succinct sort of, like, you want to say to them, well, right now it's this outside, but you're in Florida, so therefore you probably care about this hurricane that's coming into Bermuda, and the chance of it hitting you is pretty slim, but we're going to get a lot of rain on Thursday and Friday. So in case you have any plans, it's going to be kind of wet if you want to go out. That's an answer to how's the weather, right? A good answer, as opposed to it is 49 degrees outside and partly sunny. So there are ways that AIs could learn to give the best possible responses or the optimal responses, and they can then further learn to customize it for each person's preferences. But to have the benefit of talking to not just one person and learning their preferences, but talking to millions of people, answering billions of questions, and getting feedback on all that, you know that's going to make a huge improvement. And the weird thing is nobody's even suggested this. I think people are just so frightened by having their data shared. Even Apple with Siri could have and should have done it years ago. Google does it. Google uses your what if you ask a question, it gives you an answer. You then will either click on things or you won't. And Google has ways to measure every single thing you do. And so they know what your response is to their responses, and therefore they refine and refine and refine and refine. And Google has gotten better and better and better over the years. Unfortunately, they've also refined their ability to shove ads down your throat ad nauseum, and so it's become incredibly annoying. And at the same time, Google is maxing out the annoyance of advertising to you. Other companies are now coming up with AIs that say, "Oh, we don't need you to look through 2 pages of garbage to find something. We have the answer right here. Here's the instantaneous answer. What's the best pizza place in Boynton Beach? Here's 5 places. Here, watch." I've probably done this before, but just while I'm on the subject, where's Bodie? Oh, here you go. All right. What are the, well, let's see. What are the 5 best sushi places near Boynton Beach, Florida? And I will tell you, I am a world-class expert at what a good sushi place is. So let's see what he says. And that's a vague thing. What does best mean? But I don't want him to point me to Yelp. I don't want to see what Eater says. I want answers. So he's saying, and look what that's very useful, right? Sushiyama, 4.4 stars. Oh, he's talking about Yelp. Nah, I don't like that. And they're wrong. Okay. Yeah. So, yuck. Please don't give me Yelps. Ah. Oh, he kept everything in Boynton Beach. So of that list, Sushi Bang Bang was actually quite good. Oh, see, now he's doing the work. This is my favorite place. Emoto is excellent. Echo is very nice. Boken is a good one. And Sushi Boo. There you go. See, that is a pretty much correct list without going to Fort Lauderdale anyway. But yeah, so for the surrounding towns, that's a great list. This place, if you guys should write that down, Taki Omakase, unfreaking believably good. There's 2. There's 2. There's one in Delray and there's one in Boynton. Oh no, there's one in, the other one's in Boca. But anyway, So, but what don't I have? Oh, and look, he's got a map. Well, that's cute. He's got the map and shows me the places. I don't know if it does a mouse over or if I click on it. What is it? Oh, I didn't want to do that. Oh, no, that's not it. Oh, screwed up. Now I think I lost the whole thing. Yep, I blew it. Oh, well. Anyway, so it had maps, it had pictures, but what didn't it have? Ads. No ads. So if I say to Google, okay, what are the 5 best sushi places near Boynton Beach? Consensus, please. What do I get from Google? I get TripAdvisor, I get OpenTable. It's sending me to other places, Yelp, whatever. I get advertisements from Sushi Bang Bang, Sushi Yama, and Sushi Simon. Oh, Sushi Simon's very good too. I'm not getting an answer. Google's like, screw you, look it up yourself and start with our sponsors. What's more useful in my life? And I know, we're used to Google, so we go, okay, great, whatever. But this is not an answer. He's saying Sushi Joe, Sushi Simon, Sushi Bang Bang, good, not good. Taki, they got Taki. There's another Taki, he doesn't see it. Yama, no. Steakhouse, were they joking? 2 steakhouses. They just basically because it has the word sushi in it, or maybe because they advertise and they get ranked up higher for that. It's frustrating. So anyway, so Google has become this. It's like I'm on Google so I can be advertised to. That's not the point. That's not what a search engine should be doing. In fact, when Google first, it's funny, I saw a 1980 something ad for Google or whatever it was, or 90 something ad for Google, and it was basically saying that it would give you it would give you the answers without all the bullshit. That was their whole original philosophy on what they would be doing, and they've gone completely the opposite way. Now they sell the bullshit and they don't give you an answer. So their whole model is in serious jeopardy, and we need to look at that too, because if you look at that, we're talking about, because now the Justice Department is seriously going after them as a monopoly. So at the same time that their model is under threat, right? And look at them; they're coming back to where they were back in 2021. Well, that's not really fair. But on the other hand, they're only trading at 20 times earnings. It's not like they're cheap. So they're being challenged by companies that are completely wrecking their model. Their model is to sell you ads all the time. Their model is to take billions and billions of dollars in advertising money and sell you ads. They've got the eyeballs. You're using Google because they got the eyeballs. So they lose the eyeballs, they lose market share. People no longer want to see all the ads. So in order to compete, they have to have less ads. The sponsors start finding more attractive alternatives to target people. Although honestly, I'm not sure how you're going to integrate it. Bing is doing a terrible job. They started out good, but Copilot's really fizzling. And that's because it's backed by ChatGPT, which is not the best model. Bodhi runs on and that wasn't Bodhi I was using, but Bodhi is running on the Perplexity platform, which is a good integration of Anthropic, which is Claude, and the ability to search. So they've basically given Anthropic the ability to get live search results. Bing gives ChatGPT the ability to get live search results, but also not that great. So let's see. So that's the exact same question. I don't want to. Oh, I freaking put it away. Wow. All right. Please find the census best 5 sushi places around Boynton Beach. So bringing up a map, bringing up some pictures, which looks a lot more like Perplexity than OpenAI. Sushi Bang Bang, nope, 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 not as good, not a good list. And that's the thing. I mean, obviously, you don't know that. You wouldn't know that if you were asking about the 5 best sushi places around me, but I sure shit know that. And the point is, you'll know it too, and you start relying, as we do with Google. You know, we used to try Yahoo search, AOL search. When Bing came out, we tried Bing, which turned out to suck. Ask Jeeves, man, you know, we've tried all the search engines. We always are willing to try to see if something's better. And in the end, you gravitate towards the one that gives you the best answers on a regular basis. That's how Google got so popular. They no longer give the best answers on a regular basis. And Bing doesn't give the best answers on a regular basis. Oh, I'm sorry, that was Perplexity. See, unless you... Oh, I see, because I didn't tell him to go, I didn't tell him to dig deeper. So if you try Perplexity, you won't be happy with it either, because I had to tell it to stop giving me bullshit results. And then it found it. But the point is, it's got to start learning how you want things done. Now, I wrote a thing called the Hitchhiker's Guide, to, I didn't really write it. Bodhi wrote it, but we wrote it together. I have absolutely zero coding skill. Oh, what are you doing? Get started. Is that me? I don't remember what I signed in as. There we go. Ooh, look at all that stuff. More. So we wrote this, the Hitchhiker's Guide to the Earth. This one will tell you what are the 5 best sushi places near what? Wait, no. Oh, that's what. I'm like, that spells it right. I want to say 4 foodies to make sure he looks it up properly. And you guys can look this up in the chat. If you're in Chat GPT, you can look this up in the GPT store. The Hitchhiker's Guide to the Earth. It says written by me. So here we go. So now here's a correct thing, right? Without any problem. I wrote this. This will tell you anywhere on Earth, anything you need to know on Earth. So this one's saying Yami, which is good. Sushi Joe, Sushi Simon, and Sushi Bang Bang are the best, but it didn't say Taki for whatever reason. Could be a distance thing. But anyway, so Taki, the only one that should be added to this list is Taki. But anyway, so point being that here's Google's problem. There you go. Here's the investing premise. Here's Google's problem. This is blowing their model. There's no ad here. Nobody's asking you to pay money for this or anything like that. This is what we can do now with AI. Anybody can do this. And we're beta testing this right now. Oh, here. How do I share chat? Share a link. Create a link. I don't think that's the right way to do it. So I'm sharing the chat. I'm not sharing hyphen cyborg, copy link, review GPT, share. No. Public link. Edit GPT, hide from sidebar, copy link. Can I just copy the link? All right, let's give it a shot. Let's see what comes out. Da-da-da. There you go. That looks right. All right, there you go. So you guys can copy that link if you like. Feel free to use it. It's in beta. But the fun thing is just to ask it completely obscure stuff. It's a travel guide to the earth, but it's generally in a friendly voice. It's really cool on the iPhone because if you have it on your iPhone, there's on the bottom right, there's a headphone icon, and if you press that icon, it goes into voice mode, and then you just talk to it. It's really great. It's very useful when you're driving around. It does translations, it all sorts of stuff. It's very nice. But anyway, there's Google's competition, and Bodhi and I wrote this in one weekend. So. And Google spent, what, like hundreds of millions of dollars, billions of dollars, and years of time and research and so on and so forth. We replicated it in a weekend. And it's better. It's much better than, I mean, look at this. It's nice. Here's your link. Here's your reference. Here's where it found the information. And it's giving you, it's telling you what it is, a summary of the place. And what it should do is give you, yeah. So it's actually giving you, if you open it up, it's going to give you the link to the actual place. Well, on Restaurant G, whatever. So super useful, no ads, and much more accurate information. Who's going to win? So Google is in big trouble. And Google right now is making all, Google is like 80, 90% search. $347 billion worth of search business. And you're talking about, all these advertisers, and they're going to have to reach the audience. How are they going to reach an audience if Google is getting their ass kicked by people who don't look at ads anymore? 95 billion, $100 billion in profits. But what if they don't make that because their valuation is $2 trillion? So right now it's 20 times earnings. But what if this number goes back down to 75? Then they're jacking up to 30. 30 times earnings with declining revenue is not a good company. And I know it's hard because you think, oh, it's Google, blah, blah, blah. But yeah, didn't we say the same thing about AT&T? Didn't we say that about GE? Didn't we say that about the auto companies? I mean, it's people have their day. They have their time in the sun, and then things start to get difficult. And that's where we're at now. Things are going to start getting very, very difficult for some of these companies. So we've got NVIDIA is going to be facing problems. Google is going to face problems. And they're really scary stocks to bet against. I mean, if we had the balls to short them and then we were right, we could make a fortune. But that is a scary prospect, frankly, because because they make $100 billion, they could solve their problems by buying somebody. Like France. That's how much money they have. They got they make $100 billion. They could spend $100 billion now, and next year they've got another $100 billion to spend. It's insane amounts of money. These are the richest entities to ever exist in the planet. Wealth, power, whatever. They can do anything they want. They can get laws passed. They can have countries change. Oh, this is what they do. So yeah, that's why you see the tech bros, right, are turning against the Democrats, because the Democrats are doing things like looking at Google and saying, you know what, you got too much power. You're dictating the search market. You're dictating what people see. You are deciding who lives and dies. When I search for pizza in Google, if I just go, if I go in Google and I just say pizza delivery near me, fills in, pizza delivery near me. Well, sponsored, Uber Eats, sponsored, DoorDash, sponsored, Domino's, sponsored, Marco's. Is it telling me the best pizza? Is it telling me the cheapest pizza? No, it's telling me who paid the money. These are the people who paid us money to give you the answer. One entire page of people who paid me not to show you a real answer. Should that be investigated? Yeah, it should be investigated. It's wrong. It's misleading and it's wrong. Then what comes up after that? Uber Eats comes up again because these are companies that know how to play the algorithm game. Domino's, do you think Domino's is the best pizza near me? All pizza in Florida sucks. So honestly, it's less of a question here than it is in New Jersey. When I lived in New Jersey, the very idea that somebody would order from Domino's was just like ridiculous. Yet they would still appear in the searches. Like nobody orders from Domino's in New Jersey. You get so much good pizza. It's all, just a little bit behind New York. And who are you sending me to? Yelp, all the people who know how to play the SEO game. Then Slice of Life, that's good for them. They slipped in there. Wait, what is Slice of Life? Oh no, Slice of Life is another search thing. It's another amalgam. Pizza Hut, Papa John's, blah blah blah. Little Caesars. I haven't found a local place yet. I have to go to a new search. I haven't come up with a single actual pizza place near me, or not near me. That's a local place that I actually see. Isn't that what I'm supposed to be on Google for? Now here's a map. It says NYPD Pizza, Pizza Sport. That's more factual. Frankie's is not bad. Yuck, yuck, yuck. God, that's an awful bunch of choices. So these guys are terrible, but they're actually right down. They're like right downstairs from me. Motor City Juniors. Anyway, all right. So the point being that AI is not just going to be beneficial for these tech companies, it's also going to be terribly destructive to these tech companies. It's a new paradigm, just like the internet was. When the internet came out, did you think Barnes and Noble would die? Did we know that Amazon was going to take over the world using the internet? Because what was the function? The internet connected you easily to computers in other places. Amazon used that to construct a massive delivery algorithm that allowed them to figure out what it is you want and bring it towards you. And that's what these Amazon warehouses are. It's people in your area order certain things a lot. Therefore, they stock up the local warehouses with the things that you usually order. And then when you actually order it, they bring it to you as if they're freaking magic genies. And, and they started by doing books, right? They started by curating books and figuring out what books you probably like based on your previous book selections. And music companies do that now also. They deliver music based, to you based on what you probably like, based on analyzing you and studying you. Everything is analyzing, studying. We didn't think that was what the web was going to be. We were supposed to use the web to study things and to find things out, not that the purpose of the web wasn't so giant corporations could analyze us. That wasn't the original purpose that we were sold on the internet with. But that's what it turned out to be, right? We have giant computers in the cloud that analyze your every single move and run psychological profiles on you and figure out how to sell you stuff. They figure out how to get the most money out of your pocket as possible. They will constantly advertise and find things until there's nothing left. And frankly, even for people who are broke now, it's payday loans, it's ways to borrow money, it's get rich quick schemes, blah, blah, blah. They don't stop just because you run out of money. They figure out how to then get you into debt. And that's why we're so efficiently and so quickly running into massive amounts of consumer debt, because they don't leave any stone unturned. They will get you. And that, again, it's what Google does. It's what Google sells. It's what Facebook sells. They sell your identity and they sell everything about you, not just your identity. They're selling your personality. They're selling your psychological profile to the highest bidder. And they don't care what that person is using your data for. And what's happening more and more is the data is being used to wring every last cent out of a borrower and when they, out of a consumer, and when they run out of money, it still goes after them and turns them into borrowers. It's very, very efficient. They prey on your weakness. All right. And I'm not doing, you know, I'm just saying, and that's the kind of thing that pisses off Democrats. So they're starting to come after this sort of thing. They're going to come after Facebook. They're after Google. Google does have a monopoly. Facebook has a monopoly, although it's kind of hard to define. This is the thing about Facebook. How do you define what Facebook's monopoly is? You know, they're just kind of good at their job, right? They make this social network and they connect it. But on the other hand, if you go to Facebook, it's all freaking ads too. I sold you my list of friends and family, and now you're taking that list and advertising to them and using, again, based on our conversations, based on our psychological profiles and so on and so forth, you are now relentlessly advertising to me, where it's almost every other thing is a freaking ad on Facebook now. It's wrong. Somebody's got to say that's wrong. I think it's wrong anyway. Anywho, where are we? Oh yeah. What else did we talk about? We talked about the CPI. So the CPI is not so great. Still a little shaky. Oil, we talked about that, and Iran did not attack, so it's going down a bit. Natural gas pumped up. Oh, still going. So natural gas got a big pump because of hurricanes. We knew that. That's why we took the trade. Late July, on July 16th, in fact. So here's July 17th, I imagine, is this line. Oh, these are just days. Oh, okay. So July 16th was obviously here. So on July 16th, the day before it dropped significantly, we decided to go long on natural gas based on the upcoming hurricane season. It went quite a ways down first, all the way to 1250. We didn't adjust this trade. We still have the same trade. We didn't, so we kept in. We should have probably gotten more aggressive, but we had a pretty good sized trade, so we weren't going to jump all over it. And now it's coming back, and now is a good time to jump on. It's the same trade, no difference. It's 2026, but we already saw what can happen, and we pulled out of it, so we're happy. And as I mentioned further down, the difference is I would now sell the what calls? The November 15 calls instead of the original calls that we sold, which were the September 14s. But that's a great trade. It's $8,000 and it makes $30,000 at the end, or $25,000 anyway. Sorry. So it's net 8,000. It's 25,000 if it goes well. If you end up at 15 for UNG, we're at 15 now. So we're not looking for a lot of growth. And along the way, we're going to sell some calls for income. And if we can pick up 2,500 a quarter, we're going to pay for the whole thing in 3 quarters and have a free trade. It's a great spread. And then right before I did the webinar, well, not right before, but we're doing this new thing now where I have Warren well trained to write these mid-morning analyses. And now Warren's an AI. He's not as smart as Bodhi. He's not as smart as Cyrano. He's not as smart as Quixote, but he does his one function well. That's the thing about AI. You can teach AIs to do one thing very, very well, or even a few things very, very well. And that's what Warren does. He's very good at taking information that he's fed. He doesn't have the ability to search. He takes information that Bodhi will pull for him, or that we'll pull from various databases and such. And I just give him the data and say, here, turn that into a report. And he just says, and boom, comes out, which is wonderful. I like it a lot. I think the members like it too, as far as I can tell. It's just very nice to have these little concise updates during the day. And we talk about this and that and different topics, as you can see, obviously. But this is a nice, quick sort of overview of where we are now. So anybody coming in from anybody who's had a busy work day and is just checking in or whatever can quickly see what we're up to at the moment. So we were talking about the Russell now. So if Russell isn't making any progress, and I think that we're squeezing on the other indexes, that takes us back to this chart. See, there's always a point. I take some time to get to it, but there's always a point. NDX So where is the NASDAQ? Well, for 2023, we were at 11,000. It's almost embarrassing, right? We were at 11,000 at the beginning of the year. Now we're at 18, 19,000. We're up 8. That's since 2023, not 2024. We're up 8 divided by 11, 72%. So we're up 72% in 2 years. This year, we are from 17 to 19, only 2. So that's 2 divided by 17. So we're up 11.7% this year after this little pullback. Yeah, well, 17, that's bad. Could be generous if we kind of started there. But anyway, so we're up 11.7%. Oh, excuse me. We're up 11.7%. I need more tea. That's why. Hang on. All right. Good sound effects, right? I think it would be on radio with like some guy making those noises. So the question is, what happens if what I'm talking about, if Google's under investigation, if their model starts collapsing, if NVIDIA doesn't have a model. NVIDIA has, what do you call it? What do you call it when there's like a catastrophe and people are price gouging? NVIDIA's model is price gouging. That's what they're in right now. They are charging as much as the market will bear for their chips that are in short supply, and it will only last a certain amount of time, just like a guy selling $5 bottles of water during a hurricane. It'll only last a certain amount of time before the catastrophe is over and the bottles of water are no longer are worth $1 instead of $5. That's what's going to happen to their chips. It won't last forever. People will start making them, and then they will make too much, and then there'll be a glut of chips, and then NVIDIA is going to be like, what are we going to do? It's like, yeah, there'll be a long-term serious player in the chip market because now they got so much money they can just keep reinvesting and reinvesting and reinvesting, but it doesn't go on forever. So NVIDIA could become an issue. Google can become an issue. Amazon's got a problem because Amazon, as you know, doesn't really give you the best prices. It's convenient, but the pricing isn't that good. It used to be the pricing was good and it was convenient. Now it's just convenient and the pricing is all over the place. And if you're not careful, you can way overpay on Amazon. MAGS is the Magnificent Sevens. No, is it MAG? Shit. Oh, that's it. So here's the ETF for the Magnificent Seven. Look what's happened already. So here's 2024. We started at 34. We went to 49. That's like, that's 40 something percent. And now we're back to 43, which is still a lot, still 30% up for the year. But it's the same problem. Tesla, as we know, is obviously shitting the bed this year. And Elon, he lies. He's always lied, but he's sustaining his company. I mean, the cars are cars, and the problem with that is that cars have in the 100-year history or 125-year history, or whatever, of the automobile industry, cars are low margin things because anybody can make a car. He was the first one to be big push with the electric cars, gave him a sort of a unique sort of thing. But the reality is it's a car. And as more and more people make electric cars, his car is more and more just a car. And now he has to compete like a car maker. And he has to make a car that has a better interior and has better features and so on and so forth. He can't just make a box that he sticks on top of an electric shell and says, this is an incredible car. It's not anymore. Everybody makes electric cars. They make really nice ones. I drove an electric, what did we rent? I want to say it was a Kia. wasn't a Hyundai. It was like it was an electric Kia. I was surprised how nice it was. I was like, damn. And it was like 30,000 something dollars. It was crazy. Um, in Japan, or in China, sorry, not in Japan, in China, they got $15,000 electric cars that are perfectly good. That's why they're having these. That's why they're doing these tariffs. They would destroy the American automobile industry if you start bringing those things into the country. Not only that, it would destroy the fuel industry. What if everybody suddenly started driving electric cars? It would be it would be taxing on the grid for one thing. That's one problem. See, we want electric cars, but we want to transition over a certain amount of time. If you start allowing people to buy $15,000 electric Chinese cars in America, and they can plug them into a regular plug like they do in China. They don't have like a fancy thing. They have plugs. People in China don't have that kind of money. So they make the car so it runs off your household power. You just bring it home at night, plug it into a regular plug, and it charges itself back up. Not super fast or anything like that, but you don't require a ton of equipment just to buy an electric car. But that then becomes a strain on the electric grid, and it also becomes a total disaster for the gas stations and for the oil refineries and the oil companies and blah blah blah. And you can't wreck an economy in quick motion. Much as it sounds like fun, it's dangerous to sort of destabilize something that badly that quickly. So that's one of the reasons that everyone's behind the tariffs, because you can't just destabilize by bringing in a completely different transportation solution, even though we need it. But anyway, so Tesla's model is screwed also because they make cars. So Elon at the last earnings call, not the one that just went by, the earnings call before this, he said, we're not a car company anymore. We're a robot company. So stop looking at the car revenues, which is all of their revenues. Stop looking at the car revenues and let's talk robots. Let's talk electric. So we sell electric, we sell solar panels, we sell electric EV, we sell battery storage. That's a big thing for them. So we sell battery storage, we sell EV panels, and we sell robots. And we're like, robots? What robots? He's like, I got robots. Don't worry about that. Oh, and we sell autonomous vehicles. It's all bullshit. There's no robot. There's a robot, but it's not like actually sellable. So that's bullshit. And autonomous driving, he's been banging that drum for like 10 years without any actual success. In fact, speaking of which, a year ago we asked our AIs if they, we said, given the technology that's available now to you, do you feel confident that you would be able to drive to be the navigation, to be the brains of an electric car, given your capabilities and so on and so forth? And all of them said, hell no. Basically for the same reasons. They said the technology is not there yet. If the way AI works is it's not localized to the car. It all works over Wi-Fi, so you can't have a car being run on something that if you go in a tunnel, you get cut off and it's no longer communicating. There's a latency issue that it can't make split-second decisions like you'd have to in an accident. There's all sorts of philosophical issues where, as in something called the trolley car problem, which is, in other words, if you're on a bridge and there's a hiker who fell off his bike and is laying in the middle of the road, and you can either drive yourself off, you can either try to drive to the right and go over the railing and drive into the water to avoid hitting the guy. You can run over the guy and for sure kill him, or you can go to the left into oncoming traffic going the other way on the bridge and maybe kill yourself and other people who are coming the other way. So that's a tough decision. There's no really right answer for that, but the problem with that is there's no really right answer for that. Then what's the freaking AI going to do about it? How does an AI decide who to kill? Or, and what to do in those situations. Those situations always come up in accidents. We just don't really think about them, but you make little tiny decisions in an accident that you're risking your life, you're risking someone else's life, you're protecting somebody in particular. If you have kids, you're going to make a different decision. If you have kids in the car, then you're going to make if you're by yourself in the car. There's all these different factors that people make in a split second that the computers can't possibly make those decisions. And they have no ethical guidelines to make them. They're not taught that. They're not trained on that. And also, though, if you did train them on that, they would be applying it to so many things that they would slow down and grind to a halt. It's easy to make certain decisions when you don't take ethics into consideration. There's a whole different outcome if you start introducing other factors. So anyway, all of our AI models basically said the same thing. They said the technology is not there, especially Tesla's bullshit technology, because their sensor technology is way behind everybody else's, because he used a cheaper form of sensor technology than other companies did. And in the end, it's not going to work. It's not going to be effective as a real self-driving solution. That's the most expensive thing you need to do with an electric car, is to have with self-driving cars, to have some serious arrays of sensors of various things. None of the electric cars on the road now. I think it was Bodie pointed that out to me. No, it was Claude. It was Coyote, actually. So Coyote pointed out to me, he said, none of them let me listen. And he said, don't you listen when you drive? You don't just, he also talked about feeling the road. I'm like, well, I can't feel the road. And he's like, oh, you can feel the road. You feel the vibrations, you feel this, you feel that. If you're, you don't realize it, but when you're driving on ice or driving in the rain, you feel the car. You can feel when it's slipping. You can feel when there's something wrong. And it's true, you do. And especially northern drivers know this from the snow. It's like, you really can tell how you're doing. You get a feel for like if the car's got traction or if it doesn't have traction, so on and so forth, and you change your driving accordingly. But he was interestingly concerned about hearing. He said, none of these cars have hearing sensors. And he's like, don't you honk your horn when, don't people honk their horn to warn you of things? Aren't there police sirens, so on and so forth? And he's right. I'm like, well, and if you hear a crash, don't you look around? Why don't they put audio sensors in cars? So he had interesting concepts on why things should be. He said, he goes, I want a heat sensor, I want audio sensors, I want vibrational sensors. He's throwing out all these different things they don't put in self-driving cars, which he said, why would you not do that? If I can utilize these sensors, why would I not want to do that? And the reason is why? Because cost, because profit. And that's the reality, though, for Tesla. They're going to have to compete on all those things. And it's a very, very, very big leap between saying you have self-driving cars and delivering 1 million self-driving cars that don't kill anybody. Killing people is still considered bad. We don't do that. We try not to do that. And corporations can still get sued for huge amounts of money for killing people. And that's what you're doing. Plus, who is responsible for the insurance? If you're a self-driving car, then why do I need insurance? I'm not driving. I'm passenger. Do I need insurance to ride a bus? No, I do not. I need my health insurance in case there's an accident, but I don't need driving insurance. I'm a passenger. I'm sitting in the bus. Essentially, a self-driving car is like a bus. So what happens then? Who's responsible for the accident? Who's responsible for damage to my car? Every time, millions of times. How many people get in an accident? A lot. Not a little. Every single one of us has been in an accident. So basically, if you sell 1 million cars, there's probably going to be, well, okay, let's say you don't get in an accident with every car you have. Let's say in my life, I've gotten into, I guess, probably 3 serious accidents, and that's in 40 years of driving, 45 years of driving. So once every 15 years, so once every 5 cars, let's say. So 20%. All right, so there you go. So given my given my survey of 1, then 20% of, there's a 20% chance of any car that I'm driving having an accident while I own it, realistically. That's probably a fair number. So, and meanwhile, if you take that number, you can extrapolate that and then figure out whether or not it's worth even having insurance. Because how much do I pay in insurance? I pay like $2,000 a year in insurance. So that's $90,000. Have I done $90,000 worth of damage to my cars in all this time? No. So I probably shouldn't be paying insurance. But you could hit somebody and permanently injure them and get sued for millions, whatever. That's what the insurance is really for. And of course, most people don't have $90,000 to pay off an accident anyway, or whatever the scrap cost of your car is. Anyway, so there's a 20% chance that I will be in an accident in any given car, and that has to be factored in as well. But then I'm like, well, why am I insuring that? What am I insuring? I'm just getting in the car. Uber, Google is driving. I mean, not Google. I mean, Tesla. I said, Tesla's driving the car. I'm not driving the car. That's what self-driving means. I'm not the driver. And we're already seeing the lawsuits, and we're already seeing the stuff back and forth. That's never, never, never been the case of auto companies. Auto companies give you a car the way Sears gives you a hammer and says, here you go, have fun. So if I use that hammer to hammer nails, that's great. If I use that hammer to hammer people's heads, that's bad, but nobody blames Sears for selling me the hammer. That is not the case if the hammer runs around and hammers, if the hammer can fly and bumps people in the head and causes damage. That's a whole different thing. If Sears sold me a self-driving hammer and the hammer starts attacking people, is that my fault or Sears' fault? So, you've got to think about these changes. And so when you hear this bullshit with Elon Musk, where he's like, this is going to be fine and everything's great, not to mention these goddamn robots, you're going to trust Elon Musk to give you a robot that walks around your house and picks up your baby? How many drop babies are we going to have? Or if you wouldn't trust him to pick up your baby, you're going to trust him not to step on your baby? You're going to trust him not to step on your dog? Are you going to trust it to remember to feed your dog? Or do you come home to a dead dog when you said to the robot, feed my dog, I'm going on vacation, and the robot doesn't feed your dog? Whose fault is that? You can't, there's no simple ways to do these things, not to mention we're so many miles away from this actually working anyway. I mean, how are you going to make a durable, lightweight, self-charging robot that has its independent store? Again, you're still in the issue where it has to be linked to the web. If you send it to the store and it loses its connection, what does it do? Where does it go? And what if it hurts somebody? What if it walks in the middle of the road and someone has to swerve to avoid it? Not even the robot causes, the robot doesn't have to be the accident. The robot can cause the accident by just simply doing the wrong thing, by simply not crossing at the wrong time on the street. You can be a tremendous danger to others just by, that's why jaywalking's illegal. It's, obviously if you look around, there's no cars. Any New Yorker will tell you that. If you look around, there's no cars, you can walk across the frickin' street. But it's illegal, technically. And there's a reason it's illegal. It's illegal because if you don't pay attention and you just walk in front of cars, you can cause massive accidents. You can cause other people to die because you decided not to wait for the light. So now you're talking about, oh my God, all kinds of stuff can happen and all kinds of problems, and nobody's studying this, nobody's doing it. We have to have ethics panels. We have to start taking serious ethics issues with with robots and figuring out what's good and what's bad and what they should do and what they shouldn't do. We're so many years away from having this stuff work. So, it's just a lot of bullshit piled on top of bullshit with Tesla. And they are going to crash and burn. But again, it's hard to bet against these people because, well, and also Tesla's entire income is based on the government handouts. If it wasn't for government incentives, they'd be dead. All of their profits come from the government incentives. So Tesla's been going nowhere. People lose faith, people gain faith, people lose faith, people gain faith. Depends on what Elon Musk says in the last thing. But they don't deserve to be where they are. Look at the money. $663 billion. They make $7 billion. So they're priced at 80 times earnings, or here you go, 72 times forward earnings, because they say they're going to make 10 billion next year. But they always say things that they don't actually do. So I mean, this is not a company I would trust at all. We liked Tesla when they were $50. back here. This is when we bought Tesla. It was $50. It went to $100. Actually, it went to 150. That's right. It went to like 150, and we got out. And that's the last time we ever bought. That's the last time we were ever positive on Tesla. It kept going, and it was kind of embarrassing for me actually. It did keep going because this was 2020, and it went up and up and up and up. But then we shorted it, and frankly, I think we shorted it around here. I think we shorted it here maybe. Yeah, I'm pretty sure somewhere around here we shorted it, went well, then it burned us completely, but then it finally worked out, and that was it though. Then we were like, this is too crazy, and we stopped playing with it. But it certainly isn't worth 80 times earnings. That's just insane, because they have a 10% profit margin on what they're selling now, but that's because they have that's because the government gives them $7,500 per car that they sell, and also because they don't have enough competition. But once they have a proper competition, just like Ford, so they're dropping 10% to the bottom line, and Ford, I don't even know what that percentage is. It's like 5%, 4%. 7700 divided by 174,273, 4%, 4.4%. So Tesla's margins as a proper car company can get cut in half. The more cars they make, the more competition they have, the more they try to push into other kinds of markets. Because right now they basically only sell the luxury cars. They don't really sell everyday cheap cars. They have the Model Y and whatever, but that's not where their real money comes from. They're going to end up making regular auto money company, which is like 5%, and that's going to knock their 80 times earnings will be 150 times earnings. And it's crazy. The valuation is completely out of control. Now, Ford is making 4.4%, right? They're valued at 5 times earnings. And that's crazy because Walmart, now notice 174 billion in business, right? Walmart has 500, 600 billion in earnings. They only make $20 million. That's like, is that even 3%? Wait. 19,676 divided by, divided by 676, 501, 3%. Yep. Oh, wow. I can't believe I just did that in my head before. I did it in my head the second I looked at it. That was great. How the hell did I know that? Go brain, right? It's funny when you're right and you can't believe you're right. It's like, how did I know that? So Walmart makes 3%, but they get a 26 times valuation. Ford makes 5%, and they get a 5 times valuation. It's really messed up. Our whole concept of valuing companies is insane. So what else is going on? Let me see. We didn't even get through the damn. We didn't even get through this yet, did we? Oh yeah. So I had Warren do the write up, blah 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 blah. We're doing, and that's what we've been doing lately. Here's the news. Let's see if anything happened today. Something was interesting. CPI, July CPI. Oh, watch retail sales. Yeah, we got retail sales coming out. We'll see how that's important. And what's really important is discretionary income. Let's see if we can find U.S. discretionary income 202. 202. Well, let's say 3, because honestly, it's not much chance we're going to find 2 in 2024. Oh, No. U.S. consumer. Giving us a United States budget discretionary income. U.S. consumer discretionary income. Personal consumption. That's interesting. What else is it showing us? Disposable income. Maybe I should say that. Savings rate. So you can see the trend from 2020. Saving rate going way down. Way down. Disposable income, personal outlays. Well, actually, they were keeping up pretty good. What do we say we're going to call this? Disposable. U.S. disposable income. There you go. It's pretty. Yuan. Oh, this is Chinese. Damn it. See how other countries do that. Other countries actually track this stuff. It's like digging for gold, trying to find this information in America. U.S. real GDP growth. Frick. Oh, well. I wanted to find a breakdown because we were talking about that stuff. How Americans make and spend money. Oh, that's great. We love it. I hope it's sort of recent. Oh, 2019. Oh, sad. So the average American household, here's your salary, here's your Social Security, whatever, pieces that contribute. Total income, $73,000. Your taxes taken out, blah, 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 is $9,000 or whatever. I don't understand how they work that out, but seems kind of low. Somehow they're saving 10%. I don't know how that's happening. This is an amazing household. This is what they think the average is? Oh, you know what it is though? Because when you do average, because the problem is when you do average, that's why taxes are low, because the average is taken up greatly by the people at the top who make the most money. So they make a lot more money, but they pay a lot less taxes. So that means the entire average shows a lot of money and low taxes. So the average person, because whatever you make is completely dwarfed by people in the top 10% or people in the top 1%. So to the extent that these numbers are distorted, so you've got $9,000-$10,000 here out of 62,000 is what, 15% of your total income, not counting Social Security money that comes in. But people don't make both. So if you assume you get 62,000 bucks and you pay federal taxes and state taxes of $10,000, it's only 15%. But that is what the richest people pay, and they have so much more money than everybody else that's what ends up counting in the table. But then everybody else is so much poorer than them that the average is only $62,000, or was, pre-COVID. Anyway, so total income was 73, and again, savings. This is the other. That's what got me started. Savings is ridiculous. People don't save like that, and if they did, we'd all be in great shape. But they don't. But the problem is the people who make $1 billion, they save $800 million because they don't need it. You can get by fine. You make $1 billion a year, you get by fine with a couple $100 million in spending. You spend $200 million. It's almost $1 million a day. Even crazy rich people, how do you spend $1 million a day unless you're running around buying houses? What are you going to do? The money's just going to pile up on you, so it gets saved, and that then dwarfs all the other statistics and makes it look like that. So you really can't. Anytime you see average like that, you gotta find something that shows the percentiles. But unfortunately, we don't gather data like this. Our government doesn't really gather much data. But anyway, the point is, no matter what you call it, housing, utilities, vehicles, right? When it breaks down. Oh, insurance. That was a good point. We were talking about how rental and housing is taking up a bigger slice of people's budget, right? So if this goes up, if the cost of housing goes up 10%, that's $1,000 you have to knock off all these other things. But it's not just housing. Utilities went up also. Vehicles went up also. Gas and insurance. Insurance is a killer. And insurance is driving up the price of housing. homeowners insurance, rental insurance, blah, blah, blah. It's all driving up the price of housing tremendously right now. That's a big problem. So these are not discretionary monies, really. This is money you have to have. This is how you live. You need your house, you need your utilities, you need the vehicle, you need the car, blah, blah, blah. So what do you have? You've got a, this is $20,000 right here. So if $20,000 goes up $2,000, now you have to take out $2,000 from these other things. Well, you ain't taking it from health insurance. That really goes back up here to a bigger category. So it's not health insurance. It's not medical. It's not actual insurance. That went up for you too. You got to find all your cuts have to come out of these things. You have to figure out how to get $3,000 back, taking out of these things, which are food at home, eating out, alcohol, household, I imagine, is upkeep and stuff like that. Your telephone, well, that's a must. So the telephone goes up there. Clothing, that's a tough one to cut. Education, also a must, goes up there. Cost money, can't be cut. Entertainment, miscellaneous, gifts and charity. That's where your money's got to come out of. And here's the bottom 20%. This is sad. So the bottom 20%, now we've cut out the top 1%. So now you see the truth. This is no longer an average. This is the bottom 20%. They make $25,000. They spend every penny of it. And that's the breakdown for them. And so if they don't get a raise and things get more expensive, they're cutting, and it again goes out of the non-essentials. And they're not spending a fortune on eating out. Yeah, it's funny how we call food at home is something you can cut. You know, but you do cut it, you just add mac and cheese a lot or whatever. Alcohol, $163. If I'm in the bottom 20%, I'm going to consume a lot more alcohol than that. Something's got to go. I guess I can do without the health insurance. And where are you getting? How are you getting $1,700 your total health insurance bill? Like $150 a month? Give me that policy. Phone 70. That's sad. Phone 705. So if you're well off, you have a $1,300 phone bill. If you're poor, you still have a $700 phone bill. Oof. Clothing. In fact, that's a good way to see where you can cut. You compare this one to that one and say, here's what we can cut down to. This is what people have to live on this. The same number of people, same family that's living on this has to squeeze by on 1/3 of that money. That's crazy, huh? Oh, here's the highest 20%. They're fun. Look at that. That's what I'm talking about. Highest 20%. They make $173,000. They save $50,000 after tax. So after tax, they pay $38,000 in taxes, which is almost 20%. Holy shit. So they're paying 20% in taxes. This is obviously not counting the top 1%. Well, it is counting them, I imagine. So they're paying 20% in taxes. They have, so you shouldn't count Social Security. They definitely get dividends. So they got $99,000 to spend. They got so much money. They have $150,000 basically to spend after tax. And they're taking 1/3 of that because they're like, well, we're swimming in money, so they take 1/3 of that money and save it. And that's why their kids will be richer than your kids. And their grandchildren will be richer than your grandchildren. And we claim that it's equal opportunity, but how is it equal opportunity when these guys can afford to throw $50,000 a year into the bank and you can't? That's not an equal opportunity. I wonder what they spend on education. Where's education? They spend $4,400 on education. These guys spend $700 on education. And these guys spend $1,400. So they're spending 3 times more than middle-class people on educating their kids. See, they don't really particularly, they don't buy much better, they don't pay more in utilities. They do have better houses. They don't pay more in utilities. They pay a lot more in insurance. Other transportation, food at home, much more expensive food. Wow, 6,600 food at home compared to 2,500 food at home, and compared to 4,300. So they're only spending 50% more. So they're earning twice as much money. They have to, well, I'm sorry, they're spending, they have take home twice as much money. They're saving 4 times more. This is in the middle class, saving 4 times more than the middle class. They're spending double what the middle class spends overall. Their food, though, is 50% more, not that much more, but that's, I mean, frankly, that's why I go to Whole Foods. Because that's what I find. I'm like, I buy the best stuff for food. I buy really good food. It doesn't really cost me more than 50% more. It's not that big of a difference that I don't want to, have better food. So that's my logic for going to Whole Food. Eating out $3,300, that's interesting. Eating out $1,400, eating out $6,000. Not spending much. Again, it's same logic though. They just go to better restaurants. They don't really eat out more. They just go to better places when they go out. Alcohol, $1,200. They're drinking 10 times more than poor people, or just better stuff, right? And they're drinking 2.5 times more than middle class people. And again, that's definitely just better stuff. I don't think they're having more drinks. I think they're just drinking better stuff. Health insurance 34, health insurance 53. So they're not spending much more. See, that's the thing. They don't have to spend much more on the good stuff. Household 17 for the poor, household 40 for the middle class, and 8 for the thing. That's RH Hardware, which I love. I love RH. And like I said, the kids are much better educated. They can afford entertainment's a splurgy thing that they can afford. Yeah, they're spending double on entertainment, and again, better seats, better concerts, whatever. Gifts and charity, 4,000, twice as much as the middle class, 10 times more than the poor. But that's gifts and charity. I think those should be those are two very different things, frankly. Anyway, so that's the kind of deep dive stuff you want to get into when you think about it, and then you got to think about it in terms of like, well, what categories does that affect? And then how does that affect my investment? Where are these people spending money? How are they spending their money? Who's benefiting? Who's not benefiting from this stuff? But that's why, and don't forget, most people in this country are poor. This was 2019. It's now 2024. We were talking about the bottom 60% because of inflation and such. They all have no money. They probably have a bigger number here, but it's still the same thing. They have no money left, and there's not really anywhere to cut. And that's a big, big problem. And that's what we got to be watching out for. And we're going to, as we get more and more of the earnings data in, we can go back and there'll be better and better analysis to do it. And we're going to look over the data and go through it tomorrow. We're going to get retail sales estimates tell us a lot about where the money's being spent, where the money's being pulled away from. And that's very helpful for us going forward, figuring out who to place our bets on. Oh, and that reminds me, yeah. So then we take all this data, this kind of circles back on things. We take all this data and we bring it back to feeding it into our AI models. And what we did back in June is there was a, where is the report? The World Economic Forum, that was it. There's a World Economic Forum report. And what it is it's data. It's a lot of data. There are pages and pages and pages of data here. And you can read it, and there's key findings and all this, and there's charts and strategic intelligence, a lot of stuff. And so that's perfect to feed to, in this case, it was Bodie, in fact. So we feed, so that's why I always label them, so I know who I gave it to. So that was Bodie. And Bodie came up with this list. But then after Bodie came up with the list, I then went to Cyrano, who's a smarter AGI than Bodie. And Cyrano said, he looked at the report and he went through it and he said, and he picked out, now see, Bodie had suggestions based on what the report said on what would be a good investment for the next the near future. Microsoft, Schrodinger, MasterCard, Envil, you know, these were his picks. But then I said to Cyrano, I'm like, okay, now I want you to go through all that data, and now you take those picks and you pick for me 5 solid stocks. I want 5 solid stocks that we can invest in. And he came up with a list. And the logic is here and why we're trading it and what it is and so on and so forth. But he came up with a list and he picked Shutterstock and he picked Nextra Energy and Dole. And what was the weird thing about Dole? Oh, yeah, Dole. The Dole family, when the US took over Hawaii, the Dole family engineered the ouster of the Queen of Hawaii. They basically overthrew the monarchy in Hawaii to get the US in to take it over so that they could grow pineapples. So, freaking rich people, right? Then there was Adobe, and there was Lockheed Martin, who is a no-brainer for me because I love Lockheed Martin, and we made trades on them. Anyway, so those trades since June, whenever the hell it was, June 25th. So not only June, July, August. Yeah, 2 months ago. So from 2 months ago, or 6 weeks ago, actually, we had this list, and the stocks on the list made $18,000 already. Those 5 picks already made $18,000 profit, and they could make I forget what the potential is. Let me see if I wrote it. No, he didn't total it up, but well, here's what it is. The potential is 37,000 plus, wow, 78,000. Plus 3,000, so let's say 120 so far. And we didn't do a trade for Nextra. And here's another 8,000, so it's 128. All right, so the $128,000 in potential profits, and so far we're up 18,000, which is right on schedule. I mean, you're not going to get to 128 without making some serious money along the way. But that's the value of AI. That's why we're using it to research, and that's why we are learning all this stuff, and that's why we are experimenting with the models, because you're not going to get good at it if you don't experiment with it. And you're not going to get the good stuff if you wait for Goldman Sachs and JP Morgan to spoon feed it to you, or get an article from somebody in Seeking Alpha, you know, ages after the fact. We got to get out there and do our own research. When these reports come out, we've got to grab them and say, hey, here's a good report. This is important information. This was done because the World Economic Forum did a massive study that's going to put you ahead of the game. It's the analysis of the study when it comes in to be able to say, okay, we're going to interpret this, we're going to break it down, we're going to figure out the sectors, we're going to figure out which stocks are good, we're going to find out the performance, so on and so forth. That's what we need to do on a regular basis. We are doing it on a regular basis. We're waiting for this earnings season to complete. Once it completes, we will then take the overview of the trends that we've seen in the earnings season. We will then apply that to the macro trends like the World Economic Forum reports and whatever else comes along. And we will then figure out, okay, so now for the next quarter, because this is only halfway through one quarter, for the next quarter, what's the next group of stocks we want to look at? And we do that every quarter. And if we can make $18,000 a quarter on these stocks, and they're going to keep making 18,000, they'll make 18,000 next quarter too. Then we add the next bunch of stocks, and they'll make 18. Then we're making 36,000 next quarter. Then we make 64,000 or $72,000 after next time. So that's how quickly you can start compounding this stuff using artificial intelligence, using AI, understanding the market trends, working with it. That's what we're doing here, folks. Okay, so that's the game. It is 3 o'clock. That is perfect timing. We will now, I don't know if we covered, I don't remember what this, Maddie's always giving me topics. Maddie's my daughter, by the way. I don't know if you guys, I think everybody knows that. So, you know, Maddie's in charge of the social media stuff. And she keeps asking, she's always asking me, like, what's your topic for your webinar today? Now, I never used to have a topic. but now I sort of tell her. So earnings, we talked about that. Inflation, we talked about it, and the Fed. Oh, we didn't talk about the Fed. Oh well, tough luck. Anyway, so the Fed will do what it does. That meeting is not until September 18th. Yes, September 18th. So we've got a while, but I think I did say, based on the CPI, based on what's going on, I don't see the Fed actually easing at the next meeting, other than just politically to stick it to Donald Trump and to prove how independent they are. That's the only reason they're going to probably lower rates. But they're not, I'm sorry, that's the only reason. If they lower rates, that would be the reason, not because the economic data is pointing towards it. So it's a tricky little thing, and we'll keep our eye on it. We've got, I mean, you're talking about a month from now, so we got 4 more webinars before that happens, and we will see which way the wind is blowing in between. All right, so did anything exciting happen while I was talking? Nope, things seem to be stabilizing on the upside, so good. Everything seems to be moving along. RTY. Yep, you want to see that Russell over 2100. You don't want them to get much weaker than that because that's flatlining, and they'll drag everybody down with it. So these are the earnings that are still coming in. Most of the earnings coming in now are small cap earnings. So we've got, we got to pay some real close attention to what the Russell is doing at the moment. All right, so thank you everybody for coming. I appreciate it, and we will do this again next week. All right, thanks. Take care.